Good morning, everyone. Good morning, and welcome to ALKA and RHEA show. Thank you so much always for tuning in to the show, and for the new viewers who want to know more about the show. Well, the show is about real estate and mindset. And RHEA, she talks about the real estate, and I talk about the mindset. And together, her and I, we bridge your gap to success. Today, RHEA is going to be taking over the conversation. But before she does, I want to introduce ourselves. My name is Alka.
My name is RHEA, and welcome to our show.
RHEA, going to pass the mic to you.
Thank you, ALKA. So today's topic is a continuation, Wealth Without Cash by Pace Morby. So let me share my screen. All right. So today we're going to talk about the subtail and novation. Remember, there's 4 ways to exit and make money. Previously, we talked about the wrap exit. We talked about lease option. And now we're going to talk about subtail and novation. So this is just a brief diagram that I created, and this is what we're going to talk about. I'll go briefly on each of these. So, to make it simpler, what subtail exit means and novation agreement. So imagine you're 10 years old and you want to understand this using toys instead of houses. And we're going to translate that to houses as well. First, what is our goal? So the investor wants to make money by helping someone sell their home. So there are different ways to do that, and I'll discuss it here. Think of it, so instead of buying a home, think of it as if you're buying a bicycle. In this case, an old bicycle. You want to fix it up and sell it for more money. So, according to the book, there's a traditional house flip. There's 3 to 4 methods that I'm going to discuss on this subject to and novation agreements. So first, traditional house flip. A lot of us know about it, but I'm going to explain here even further. So imagine an old bike costs $150 and you borrow money from the bank. You spend another $25 to fixing that old bike. So now you have $175 all in. Now, after that, it looks everything brand new. Your bike is spanking brand new. Now you are selling that bike after your repair of $225. So after paying back the bank, which is $150, and the other costs associated in selling the bicycle, you keep what's left. The problem with this traditional house flip is you need a lot of money at the beginning. Not only do you need a lot of money in the beginning, you also need to borrow money from the bank. And that means you need to have a good credit score because the bank won't lend you money if your credit score is not good. So if you don't have a good credit score, this traditional house flip may be a little bit challenging. You can also borrow from your family or friends, right? You can borrow from sharks or other lending institutions. So this would be others. So now let's convert that bike into a home. So for a traditional house flip, remember you're getting a loan from the bank. So the purchase price of that house is $150,000. Now, after all repairs, because as always, there's always going to be some repairs, whether it's a minor outside exterior work, some repairs in the bathroom or kitchen, there's always going to be some repairs. Closing costs of about 3%, 3% of 150 is about 3,000. And then you have lender's fees and interest because you're borrowing from the bank. It's about 7,000, and your down payment of 15,000, which is usually in this case 10% from your purchase price. So imagine the money you need upfront to buy this property is 50,000. So not a lot of people have 50,000 left and right. And now, if you're lucky enough, you're able to sell this property for 225,000. Now, your profit before other costs is 25,000. So not a whole lot, right? And you have to consider that you're holding maybe 3 months, 4 months, right? Because you have repairs. So the goal here is to flip it faster. So you don't have a lot of interest to pay to the bank. You don't have a lot of electric, taxes, things that you have that's eating up your interest while you're owning the property, while you're getting it repaired. So that's the traditional house flip. Now, subject to. Now, again, imagine your friend has a bicycle and he still owes money on, okay? So your friend has a bicycle, they bought it, but he still owes money on that bicycle, and you don't have a bike. Now, instead of getting a brand new loan, you say to your friend, I'll take over taking care of that bike, and I'll keep making the payments. So, for example, if your friend, doesn't want the bicycle anymore, and so you tell him, hey, I want your bike, and I'll keep the payment the same as what you're paying. I'll take over the loan. You're assuming. So the loan stays the same. I did not get a new loan. I did not get a new bike. I just told my friend, hey, I'm going to sell your bike. Let me assume your loan. So you just continue paying the old one, his old loan. This is now called the subject to. Subject to your friend. You're taking the property subject to the existing mortgage of your friend. Now, subtail, existing loan. This we discussed already in the beginning, the traditional flip where you borrow from the bank. The subtail is subject to the old friend who has the old mortgage, right? So now let's flip it to a real house. You buy the house subject to the seller's loan. Fix it, then sell it to a retail or normal buyer. So for example, your friend has a house. Okay, this is the old house of your friend. And your friend's house is worth 150,000. Now you tell your friend, hey, friend, don't even do anything. Don't fix it. Let me take care of the fixing. And I'll assume your mortgage. I'll pay for that. You don't have to worry a thing. So now all you need to do is not come up with 150 with a traditional flip. All you got to do is come up with a 25,000 to repair. And then you find a buyer, right? The retail buyer, so that you can sell the house for 225,000. Now, subject to subtail is easier because your only money coming in is for the repairs, right? Your loan, the loan, you don't have any. The loan is from your old friend. So that is subtail, subject to the existing mortgage, subject to the retail. Now, subtail or subject to retail. This is the author's own name, subtail. It simply means buy the house subject to, you fix it up, and you sell it to a regular family. You don't want to keep the house forever. You just want to own it for a short time. You have the control of that house, what repairs you want to do. And then you want to sell it. So think of it of borrowing a bicycle, making it shiny, polishing it, and then selling it. Now, why do we do this? Or why does one do it? Because getting a new loan costs money. There are fees Okay, there are fees, title fees, transfer fees, you have insurance, title insurance. You know, there's a lot lawyers fees. There's a lot of fees involved when you are borrowing a new loan. That's why people do this, because they're just subject to the existing friend who has an existing mortgage. So the bank charges loan fees, closing costs, interest, down payment. That's just the bank. That's not even the titling. That's not even the transferring. So using the old loan can save thousands of dollars. This bank charges alone cost thousands of dollars. The transfer fees, those insurance fees cost another thousands of dollars. So imagine the savings you will get with using Subtail. So here, for example, traditional flip versus subtail. So let's look at the subtail or subject to. So the purchase price is zero. Remember, this is subject to your friend, to your old friend who has an existing mortgage, and now you only have to pay for repairs of 25,000. And the closing costs, because you're selling it, right? So you have the closing costs less 3,000, and then you have the realtor fees if you use a realtor, which is 3%. So now the money needed upfront is around 35,000. Again, that's repairs, closing costs, realtor fees, and now you're selling it for 225,000. So the profit before other costs is now 34,250. So by using the existing loan, you save about 15,000 and may make about 9,250 more in profit. Then you'll say, well, how did we come up with 15,000, RHEA? So that's 34,250. This is just an approximate, okay? They made it simple, minus 25,000. So that's around well, 9,250. That's you made the profit. You save 15,000 because you are avoiding all this closing, the other fees, the lender fees and interest that you have to pay, plus the down payment you have to pay. So that's why there's a lot of saving when you're doing this. Now, example from the book, the house price again is 150. After fixing it, it's worth 225,000. The repairs is 25,000. So instead of the traditional flip where you're borrowing 150,000, the investor keeps the seller loan in place. They only need money for the repairs. So that means there's less money invested, only about 25,000 in this example, less risk, potentially more profit. So that's what it means. So now we talked about the traditional flip, we talked about the subtail, and we're gonna deep dive on novation agreement. So what is a novation? This one is different from the one we talked about. Now, imagine your friend, okay, wants to sell his bike. He has a bike and he wants to sell it. And then you find another kid who wants to buy this bike. So instead of buying it yourself, right, buying your friend's bike, you help them make a brand new agreement. So this is A and this is C, and you are letter B. So A plus B equals C. So you help A sell his bike to C. So you actually you actually help them together, right? That is the novation. You help them make a brand new agreement. The bike goes directly from your friend to the new buyer. The bike goes from your friend who has it, right? That's A. And C is the person who wants to buy it. You get paid for putting the deal together. Okay? You get paid for putting the deal together. You're the matchmaker. You're the finder. finder's keeper, right? Finder's fee. This is what you get, finder's fee. You may never own the bike. So this matchmaker finder's fee, that's called novation agreement. Now, how is it different? The subject to, you actually become the owner. So seller, and then you transfer it to the new buyer. With novation, you help make the sale happen. You are never here. You just match them together, right? You make the sale happen and you earn the finder's fee, the match fee. So you are not the owner in here. Whereas the subject to, you are the owner. You assume the loan. Remember, you assumed the loan of your friend's existing, subject to your friend's old mortgage. You assume the loan. So why would a seller like this novation? Maybe because they want more money. Maybe because it's a faster sale, right? Because you're not involved. You just match them together. There's less stress, no money coming from you. All it takes is your saliva, your public, your rapport with your friends and the new buyer, and someone else to handle the repairs. Because my guys tell you, the repairs can be, like magnanimous. It can be a lot of money. It's like opening a can of worms. You do not know what's inside until you open the can of worms, until you open the can and it's filled with overflowing worms. So that's why there's no money involved for you. Like I said, it's just the saliva, right? You just talk. The investor solves those problems. So why would the investor like this? Because may use less cash, avoid getting a new loan. They don't have to they don't have to fix the house. They sell it for more money and then earn a profit. But there are dangers, according to the book. This is not an easy trick. The investor must understand the real estate law. The investor must understand contract because you are merging them together. The investor must understand mortgages. The investor must understand closing documents. The investor must understand repair costs. The investor must understand the local housing market. So some mortgages have a due on sale clause. This is very different. So due on sale costs may allow the lender to demand the loan be paid off, all of it, if the property is transferred. That makes the legal advice and careful planning important. What does that mean? So especially if you have a friend and you're assuming the loan, right? That alone, because there's a change. Now, the lender, if they know about it, may say, hey, there's a due on sale clause in here. I need you to pay off all of the loan. So instead of 1,500 mortgage, now you have to pay all of the 150,000 mortgage. So that's why you have to understand all the risks you're getting into. So now the summary. Imagine houses are like used bicycles. Traditional flip, buy the bike with a new loan, fix it and sell it, right? Like how you're buying a home. Subject to, you keep the old loan of your friend, you fix the house of your old friend, and then you find a buyer. You sell it. Subtail, you buy it subject to, and sell it quickly to a regular family. Novation, you help the owner sell to someone else without owning the house yourself. The big idea is solving the seller's problem while trying to make a profit. But again, only do it after carefully understanding the legal, the financial, and practical risk. So this is the diagram I showed to you earlier. This is how I explained it to you. Now this, so I went through this chart. I went through this chart with you. Now let's try to do this chart here. Now how this deal works, okay? Traditional flip, again, bank, you get a loan, you are the investor, you buy it, and then you buy it from the seller, and then you fix and then flip it to a regular family. Subtail, which is subject to retail, the seller has a house and the existing loan stays in place. You, the investor, takes the title. You buy it, right? You own it. This is the due on sale clause if the bank finds out. Now you fix it and then you sell it to a regular family who wants to buy this house. Now with novation agreement, you are not involved. You are not the buyer. You are not the owner. Okay, you bring the buyer. This is the new buyer. And then you get paid for the fee. Here, subtail versus novation. Subtail is subject to retail. So do you own the property with subtail? Yes. Novation? No. Remember, you are matchmaker. Who takes the title? You. So be careful with the undue clause in here. Right? Undue clause. Undue demand clause. Because you are an owner, you have the title. The loan stays in place. Yes, you take over the payment. With the novation agreement, no, the new loan will be in the buyer. The main goal for subtail, you buy it, you fix it, and sell for a profit. Novation, you help the seller sell for a fee. You get the finder's fee. Okay, the finder's fee. Risk, medium, because why? You own it. Remember the due on clause? That's the risk right there. Novation, you don't own it, so there is the risk is lower. Money needed upfront is less because now you have your friend who owns the home, and novation, very, very little. So, seller's problem could be he's behind on the payment. Why would the person sell a house, right? He's behind on the payment or need to move, or it's an inherited property that the kids don't want to deal with it. They're not, like landlords, so they want to get rid of it. Or they're tired landlords because, landlordship has problems, right? The 3 T's, tenants, termites, toilets, and that's very costly, and other problems that the seller may have. So now you come in to provide the solution. Either you buy the house subject to, or you help sell it, called the novation agreement. So here, everybody wins. The seller gets out of their problem, the buyer gets a nice house, and you make the money. So make money the smart way. Work smart, and you help people, and you make profit. So this is subtail, subject to retail and novation agreement. Let me know in the comment section below what you learned from this topic. Stay tuned for more of the ALKA and RHEA show.
Yes, absolutely. What did we learn, viewers? If you want to post in the chat, what was your takeaways? And for me, when it comes to flip, to have money, that you have to have a good credit score, right? Regardless of any real estate investment you get into, whether it's flipping or wholesale, buy and hold, is going to have a good credit score. Share with us, RHEA, what happens if you want to may have an investment, you want to purchase a real estate property, you're building a portfolio, but however, you don't have a good credit score. What can people do in order to build a good credit score? Where should they go in order to do that? Because some banks, if you're an A-type bank, they are very strict, right? They're very
That's right.
strict. Exactly. So if they're very strict on what they want, they're very particular on the documentation. So share with us, where can people go to start off? Is it, in order to build up on the good credit score, right?
So banks, right? A lot of times the lender wants security when they give you the money because it's a big amount. So they want to make sure that you check the boxes. So when you check the boxes, it's the same requirement. One, they want reassurance of them getting paid every month. One of the things that they look at is if you're employee, actually. So if you have W-2 income, employee, that means that you're getting income every month. And they like to
Mm-hmm.
see that, because now if you have a job, you have the job security, you have the income every month coming in, they can get paid. So if the property, if the rental is not performing, then they're assured that you are able to pay for that loan through your W-2. Okay, so you're able to pay that. Now, the other thing that what they would look for is the credit score. Now, you ask me, if a person does not have good credit, how can they build it up? One, what is the cost of your low credit score? So, for example, I have a lot of tenants who are from international countries. So when they come here in the USA, just like when I came here in the USA, I didn't have any credit history. So that takes time to build credit. And so when you
Mm-hmm.
come here, you look for, cards from the bank. You open up credit cards, or they have a debit card that would report to the credit bureaus. And then what you do is, it just needs time. You want to make sure that when you open up credit cards, that you're paying them every month, because that's slowly building up. Now, if you're here in the USA, or you're already established, and your credit score is low, then you understand why. Why is my credit score low? Is it because you have a lot of credits, right? You opened up a lot of credit cards, and then you have not been paying all this credit card, that you have behind, you're behind like 6 or 8 months, or sometimes, people stole identity, right? It's what we call identity theft, and you shut off the credit history so that they won't touch it. So that would affect the credit score. So understanding how you get into that situation would help. So if your credit was you had identity theft, right? Then it may take some time, because finding out how to correct it. Now you would have to slowly open up that credit card to soon build up that credit score, credit history. Now if you've not paid your credit, then I would recommend start paying off those credit cards, right? Because that will ding you. That's really gonna hurt you.
Oh, yeah, for sure. Exactly. And also, paying off the credit card is to pay off in the full. Never pay the
Hmm?
minimum payment, because the minimum payment, people don't realize that if you pay just the minimum payment, you're paying interest. You have to pay off the interest, and also you have to pay off the amount that's owed.
The
So why
principal,
do double the
right?
work? Exactly, yes. So why do double the work? Just pay off your credit card, any credit cards you have, pay off in full. In that way, there's less of a headache on your part. And this is how companies, credit card companies, see and they track that you are paying off your credit cards in full. And they see also, and then that's how, if they want to increase your limit, they can do so because you've been paying off in full. So amazing, amazing point, RHEA, that yes, never pay off on the minimum, pay on the max. Pay it out.
Mm-hmm. That's right. Yep. You got that.
Amazing. Exactly. That's awesome. And amazing. So amazing information, RHEA, that how people can really, when you want to buy investments, especially when it comes to real estate. And also, one question that came to mind is that
Mm.
when you want to invest in real estate, how do you know as to what's the niche? Whether you want to buy and hold, whether you want to do flipping, wholesale, what is that criteria? How do people know as to what do they want to invest in?
Well, I think it depends on the person, right? It's always about what you're comfortable in, what your
Mm-hmm,
particular exposure is. So for
mm-hmm,
example, for me, I'm not a fix and flipper, right? I'm not a wholesaler. Although I've studied those things, it takes more work, because every single time when you buy a property, remember, it takes a long time to buy, the right one, right? And
right.
then you
Yeah.
just want
Mm-hmm,
to sell it. So it really depends on your needs. So for me, I'm not a fix and flipper, I'm not a wholesaler, I'm not a retailer. But as you grow and continue to study real estate, it's good to learn all these things, because it's a very common terminology. It's a very common method that a lot of investors use. So even though if you're not a traditional fix and flipper or wholesaler or retailer, it's good to know. If I'm just a long-term investor, it's I'm buying for holding forever. So that's what I do. So it depends. Gradually, as you start, probably you may be a fix and flipper, or if you don't have a lot of money, you may be like you're helping bridge. It's like Novation. You're helping the seller find the buyer, and you get finder's fee. So there's no money involved. So it really depends on the particular individual. But in the beginning, most likely it's like Novation, where there's less money involved on your part. It's mostly solving the seller's problem and finding the buyer, and then you get paid.
That's awesome. So that'd be a good way then for people listening to, to get into initially,
Yes,
to
to get
do the
your
innovation. Right.
yes, to get your feet wet, right? To start it
Right.
out. And then as you continue to learn and grow, then you
Mhm.
venture into either wholesaler, and then you once you have a lot of money, then you can do the traditional fix and flip, because that really involves a lot of money. Remember, you're getting a loan either from sharks or from the bank, right? So that
Mhm, mhm.
requires more capital.
Right, exactly. And I've seen also a lot of people do get burnt because they
Mm,
feel, they think that, when it comes to flipping, they want to do flipping because they've seen people do that. But that doesn't mean if they were successful or they were not successful, that you should do that, because as you said, there's a lot of capital that's involved. And if you don't have enough capital to do that fix and flip, then you get screwed. And this is how people do it. This is how people lose their money. This is how people, lose their shirt, because they think that, their friend or some other individual has done it. They could have
that's
been
right.
successful or they may not have been successful, but know your limits.
That's right.
Know your limits. There is no limits, but know your limits at the same time. Well, we have come to the end of another fabulous conversation. Thank you, RHEA. And we will see you all tomorrow morning, the same time, same place. But make sure you have an amazing day, have an amazing rest of your day, and we will see you soon. Bye for now. Thank you,
Bye.
RHEA.
Thank you. Thank you all.